Wealth doesn't protect you from bad tax coordination. High net worth families tend to do many things right. They save aggressively, they invest thoughtfully, they work with attorneys, CPAs, and advisors. On paper, everything looks handled. And yet, some of the most expensive retirement planning mistakes we see happen are inside wealthy households. Not because of bad investments, but because of bad coordination and lack of communication. The blind spot isn't returns. It's not asset allocation. It's not even estate planning by itself. The real blind spot is how income taxes, estate taxes, beneficiary decisions, and retirement withdrawals interact over time. When those pieces aren't aligned, wealth quietly leaks away, often 6 or 7 figures at a time. Today we're going to break down the retirement planning blind spot for high net worth families, why focusing on one tax at a time backfires, how beneficiary mistakes undo great planning, and where coordination failures cost families far more than market volatility ever will. And before we dive into all that, my name's Ryan Knoll. I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm helping clients nationwide make smart money decisions. Let's get started. Why are high net worth families uniquely exposed? As wealth grows, planning becomes more complex, not simpler. High net worth families often face multiple account types. There's taxable, tax-deferred, Roths, and trusts, just to name a few. There's also multiple beneficiaries across generations, business interests and concentrated assets, charitable goals, estate tax exposure, and ongoing income tax exposure, just to name a few. The mistake many families make is treating these as separate problems. Estate planning lives with the attorney, taxes live with the CPA, investments live with the advisor. But retirement doesn't happen in silos. It happens over decades with money moving between accounts, beneficiaries, and tax regimes. When those professionals aren't aligned around one integrated strategy, your plan will fracture. One of the most common blind spots is focusing almost exclusively on estate taxes while ignoring income taxes. Yes, estate taxes can be quite large, but for many high net worth families, lifetime income taxes and beneficiary income taxes exceed estate taxes by a wide margin. And here's why that matters. $1 saved in estate tax but lost to income tax later is not a win. And a structure that minimizes estate taxes can increase income taxes if not coordinated properly. Examples include leaving large pre-tax IRAs to children in high tax brackets, overfunding deferred accounts with a Roth strategy, using trusts that compress income into the highest brackets, and ignoring required minimum distributions and impacts on Medicare. Estate planning without income tax planning is incomplete planning. One of the biggest coordination failures for wealthy families happens at death, specifically with inherited retirement accounts. Since the elimination of stretch IRAs for most non-spouse beneficiaries, inherited IRAs must generally be emptied within 10 years. That creates a massive tax issue when children are in peak earning years, beneficiaries live in high income tax states, and the inherited account is large and entirely pre-tax. The result is forced income stacking. Beneficiaries withdraw 6 or 7 figures over a decade, often paying the highest marginal rates of their lives. What looked like a generous inheritance becomes a tax nightmare. The blind spot isn't the rule itself, it's failing to plan for it before death. Roth conversions is estate planning, not just retirement planning. High net worth families often think of Roth conversions as a retirement income tool. In reality, they are one of the most powerful intergenerational tax planning tools available. Converting assets to Roth during the parent's lifetime can do a few things. First, it reduces future required distributions, it lowers Medicare and tax volatility, transfers assets to heirs that grow tax-free, and shift tax liability from children to parents, often at lower tax rates. This is especially important when parents are in lower tax brackets than their heirs will be when they inherit their money. Failing to coordinate Roth conversions with estate goals is one of the most common missed opportunities we see in affluent households. Let's walk through a brief example comparing estate tax implications and income tax implications for a couple who does have a solid Roth strategy and a couple who does not. Both couples in this instance are tracking to be just above the $30 million lifetime exemption around age 90 for federal estate tax. Each couple has roughly $4 million in pre-tax dollars and are currently 65 and retired. The rest of their wealth is in brokerage accounts. The couple who does no Roth conversions will have a balance around $7 million at age 90 in their traditional accounts. They also would have taken RMDs that started around $275,000 and rise to nearly $600,000 by the end of their life. Had they accelerated some income via Roth conversions, let's say about $150,000 annually, the traditional IRA balance only grows to about $5 million. Their income from RMDs is $200,000 to $400,000, and their Roth grows to about $2 million. So while the total balance of the two scenarios is both $7 million, the tax ramifications are way different. Only $5 million of the funds for the second couple is taxable to beneficiaries, whereas $7 million is taxable to the other couple's beneficiaries. Couple 2 also paid less in income tax by accelerating income via the Roth conversions at lower brackets versus the other couple who did nothing and paid taxes in higher brackets because of their larger required minimum distributions. And this isn't even trying to find the optimal output. This is a very rudimentary example of how a small change can save a couple a ton of money on income tax. Had they accelerated more of their income for conversions, they likely could have dropped below the federal estate tax exemption and saved 40% on every dollar over that exemption amount. Now let's switch gears to trusts. Trusts are invaluable tools, but they come with tax consequences many families underestimate. There's non-grantor trusts, which reach the highest federal income tax bracket at extremely low income levels. That means investment income inside trusts can be taxed aggressively. Poor asset placement inside trusts creates ongoing tax drag, and distributions may shift burdens unpredictably. Trust should not be funded blindly. What goes into the trust matters just as much as the trust itself. Placing highly taxable assets inside of a trust without coordination can undo much of the benefit the trust was meant to provide. The other thing a lot of high net worth families get wrong with trusts is on the estate side. They often think getting a revocable trust is enough to help them avoid the tax man when it comes to their estate. But revocable trusts do not help at all in that regard. Irrevocable trusts, on the other hand, can help reduce the estate. A sound gifting strategy not only removes the gifted amount up to a certain annual limit from the estate, but also any future growth of those removed assets is removed as well. Other options like qualified personal residence trusts, GRATs, and charitable remainder trusts, just to name a few, also can help on the estate planning side. Another mistake I see deals with beneficiaries. Beneficiary designations override wills and trusts, yet they are often outdated or poorly coordinated. Common mistakes include naming minors without proper trust structures, naming trusts as IRA beneficiaries, without understanding tax implications, failing to update beneficiaries after remarriage or deaths, and naming estates instead of individuals or other trusts. For high net worth families, beneficiary heirs don't cause inconvenience. They cause irreversible tax outcomes and millions of dollars. Once the money passes to the wrong structure, there's often no fix. Many high net worth families are also charitably inclined, but still give inefficiently. Common coordination failures include giving highly appreciated assets incorrectly, using cash instead of pre-tax IRA dollars when eligible for QCDs, failing to align charitable vehicles with income smoothing strategies, and missing opportunities to offset large income years. Charitable giving can be one of the most effective tools for reducing lifetime taxes, but only when integrated with retirement income planning. Next is the retirement distribution problem. Even wealthy families must eventually draw income from their assets, and poorly coordinated withdrawal strategies create cascading issues. Higher income taxes, increased Medicare premiums, accelerated required minimum distributions, and reduced flexibility later on in life. Many high net worth retirees default to spend taxable first, then tax deferred, without understanding how that affects their Roth balances, their estate outcomes, beneficiary taxation, and what long-term tax bracket they'll fall in. Distribution order is not a rule of thumb. It's a design decision that is made strategically for every individual person or couple. The most effective planning for high net worth families uses a multigenerational lens. Instead of asking, how do I minimize taxes this year? The better question is, how do we minimize taxes across my lifetime and my heirs' lifetimes? That shift changes everything. It changes who should pay the tax, when it should be paid, which accounts should grow, which accounts should be spent, which assets should be left behind, and how those left behind assets should be structured. Wealth preservation is not about avoiding taxes. It's about choosing the least damaging taxes intentionally. And before we jump to a practical example, let's take a second and hit that subscribe button below. And after you do that, leave a comment with any questions or other ideas we may not have mentioned in the video that you're using to help reduce estate and income taxes. I often find the best way to learn about new ideas is from each other. So leave a comment or ask a question, and we can all learn together. Now let's jump to the example. Let's consider a couple with a $5 million net worth, $2 million in pre-tax retirement accounts, and adult children earning in high income tax brackets. If they do no coordination, RMDs inflate taxable income late in life, large IRAs pass to children, children withdraw under the 10-year rule at the top tax rates. But if they coordinate, they have partial Roth conversions over a decade or more, strategic charitable giving using qualified charitable distributions, reduced RMD exposure, smaller taxable inheritances, and more tax-free assets for heirs. Same wealth, very different outcome. So why does this blind spot persist? It exists because advisors are often incentivized to focus on their silo. Estate planning feels done once documents are signed. Income tax planning feels tactical instead of strategic. Families underestimate how quickly tax rules change. But retirement planning for wealthy families is not a one-time event. It's an ongoing coordination exercise amongst all of your different silos. So the bottom line here is, high net worth families don't lose wealth because they lack resources. They lose wealth because their planning pieces don't talk to each other. Estate planning without income tax planning creates inefficiency. Tax planning without beneficiary coordination creates waste. Great investing without distribution strategy creates volatility. The real advantage wealthy families have isn't the money itself, it's optionality. But optionality only works when it's coordinated. If you want a retirement plan that integrates income taxes, estate planning, beneficiary strategy, and multi-generational outcomes, that's exactly what my team does here at NavWealth Partners. Thank you so much for watching, and as always, make smart money decisions.